especially once your incomes increase at such a rapid rate, to be able to have something to show for it, because I think that's the worst thing, is to earn all this money and then have 5 years down the track nothing to show for it would be quite a shame. So that's why putting in place early is the best thing to do. As I said, there are some good budgeting websites and apps, and in actual fact as well, what we've actually done at Perks is we've put together a personal budgeting package which would really suit. We've put it together really for busy professionals, because we've identified that busy professionals don't have time to manage their own finances, and so what we've done is we have a system and a software package that basically allows you to, we sit down with you, you set short, medium and long-term financial goals, and this system will help you achieve those. It means that you can actually have your desired lifestyle earlier. So, when we say short, medium, long-term goals, short-term goal might be to save for a deposit for the house.
Or put income protection in place.
Or to put income protection in place. So, a medium goal might be to take an overseas holiday in 5 years' time. And then a long-term goal might be to build an investment portfolio. So there could be, there's different, and everybody's, are going to be different. But it's setting those and then actually having a way of actually tracking how you're on track with that. So we would actually sit down and undertake a regular coaching and analysis of your spending and look at that against your financial goals, so to kind of keep you on track. It helps you, this system will actually help you learn how better to manage your own financial situation. And we do have, it's actually on any type of device, so it can be on your iPhone, it can be on computer, whichever way, so you can actually log on, see how you're tracking, input stuff in as you go. It's really hands-on but really quite simple, and we think it would really suit people who struggle, and that's just something to keep in mind. It might not be something you'll want initially, but just so that you know that is something that we actually put in place, because we really have identified, and we have a lot of high income earners within our business, clients, and we find that's a really common challenge of people is budgeting, so which is exactly why we put this in place. So in terms of savings, I guess the next thing I want to talk about is savings strategies, because budgeting is one thing, but savings is another. So when we look at savings capacity, what that is basically what's your income less your expenses. The result of that is your actual savings capacity. But it's actually about, number one, trying to actually sort of quarantine that from your regular spending. And there's different ways as well to do that. So one thing I've sort of noticed a lot with the doctors and that is, and especially once you start in your intern years and you have different rotations and you have lumpy income amounts, so you might work a lot of overtime at some period and then less. So it's really hard sometimes for you guys to budget and manage that. So there's ways that you can actually set up your banking and savings system to actually account for that. So you don't just because you're working more that you're spending more as well. So to really capture those savings is really important. Another thing you can do is identify ways to save money. So changing a habit. Sort of things like buying the coffee every day. Buying 3 coffees a day, buy 2. There's different things that you can do to look to save money, and you'll notice that there's simple little ones that can have quite an effect. Another thing we encourage is to, once you set up a savings plan, avoid making withdrawals for unnecessary, for goals and objectives it's fine, but once you, not just for the sake of, frivolous spending is really important. Once you identify that's your savings, and if you're saving towards something, really important to try and not make withdrawals from that. And I guess a lot of the banks actually encourage, they have bonus percentages and things like that if you can actually avoid making withdrawals. So that's where it can actually be quite a good way of doing it. Another thing is to maximise your savings by lump sum amount. So when you get your tax refund, if you are getting a refund, depending on your situation, putting that into your savings account as opposed to it going through an everyday banking account, which then just gets spent. Just some of those little simple things will really help you. So, and also, as I said, isolating your savings into a separate account is critical to be able to quarantine those funds. The next thing is banking strategies, which I did sort of touch on. Really, number one is to try and make sure whatever savings account that you are using, make sure that you're getting really high interest on it. And the banks can be sort of a bit cheeky. As soon as you're a client, they tend to, sometimes they're interest rates can sometimes reduce and you don't know, and suddenly you don't know what interest you're earning on an account and it's gone right down. So you just got to be really sort of keep on top of that and make sure, because there are some good accounts out there that means that you can be getting, you know, as good as term deposit rates in a bank account. So always manage the fees. You know, speak to your bank manager about getting, you know, a low fee account. I know my husband and I did that when we first sort of put all of our stuff together, went to the bank and said, look, we don't want to be paying any unnecessary fees. And it's amazing, just ask the question and suddenly we're in a different account and we're saving money, you know, which if we hadn't have asked that question, it would have been different. And the other thing is making sure you use your credit cards correctly. So when I say that, you know, if you're using a credit card for spending, pay it off at the end of every month. Just credit card interest is just it's wasted money because of course, you know, they're very, very high interest rates on credit cards. So, you know, pay them off. Even you can actually set up regular so you can swipe your, you know, so your credit card, whatever's been spent on your credit card, at the end of every month you have a transfer from your bank account to pay it off every month automatically. And some of those methods mean that, especially when you get busy, means you don't have to even try and, you know, think about it. So, assuming you've got the income to support what you're spending, which that's where it comes back to budget. So it's all a big circle really, but that's where, you know, just making sure it's all, you know, really well managed and well run. And I think you'll find that if you do this, and if you do spend a little bit of time and invest that time early, you know, you'll be surprised of flow-on effects. And, you know, when in years to come, when you look at your peers and, you know, where you're all sitting, you want to be the one who's got something to show for all this hard work. So, yeah, so just keep that in mind. Now,
And doctors are notorious for spending everything they earn.
yeah, doctors and lawyers.
Yeah.
Yeah, fine. So.
Yeah, lots of things and a lot of them.
Next one, most people think this is a really boring topic of super, but super is actually really very, very important in the long run, in retirement. And I know it all seems so far away for us at the moment, but it's really important not to ignore super. And again, it's one of these things, if you get it right early, you'll reap the rewards in time to come. You'll receive, once you start working, and assuming you haven't worked before, but if you already have, you would have already had some super put away for you. But basically the government, there is a mandatory amount that has to be contributed to super every year for you. And that's based on your salary, so a percentage of your salary, and that's called your super guarantee, so SGC, that's what I call it. That, for you guys, when you're working in the hospitals, will go to Super SA, and it has, because you're basically employed by the government, it has to go to Super SA. And it will stay in Super SA until you stop working for the government. So you don't have choice of super when you work for the government. The only time you'll get some choice is if you went to private practice or worked for a private sort of company where you could then choose where that superannuation goes. But if you're still working for the government, that money stays in Super SA until you basically stop working for the government. So we often see a lot of doctors and that who years out, or specialists, where they then would have built up quite big amounts of super, but it is in Super SA, they can't really do much with it whilst they're still working for the government. And that's just, there's benefits and pros and cons with everything in that regard, but just to keep in mind, yeah, so Super SA is where it will be for a while. One of the things that I encourage you to do is make sure that you've got, when you do start receiving super, is make sure that your investment options within your super are right for you. And again, this is a very personal thing. It's all about making sure that you've got the right allocation to growth and defensive assets, and making sure it's, you know, so some people might be quite risk adverse and some people might be willing to take high levels of risk. It's about making sure it's right for you. So just have a look, and on Super SA they've got some questionnaires where you can fill out and it will tell you what type of investor you are and that sort of thing. So just doing that exercise and making sure it's right for you is really important as well. So I encourage you to do that. Also make sure that you consolidate any existing super if that's appropriate. So if you've got existing super from a job, you know, where you've worked in a pub or at a retail store or something, to keep track of it, or I do encourage looking at that and seeing whether you think it's best to transfer that so you've only got the one fund. A few things to keep in mind though is that you might have insurance on your existing super policy, so just make sure that you've then covered off on your insurances in your new fund so that you're not losing, because if you roll that money out you will lose that cover. Other things to consider is fees, so making sure that there's no big exit fees and things like that, penalties for withdrawing the money from existing. A couple of those questions to ask, and if any of you want to know the questions to ask, I can flip them through to you. something I encourage you to do is go onto Lost Super. There is millions and billions of dollars of Lost Super that the government is trying to find people, whose money it is. And if you've ever worked somewhere, even casually for, you would have had some super put away for you. And if you've lost track and moved house and they've lost you, that's where to go. There's a website, which if you just Google in Lost Super, it'll come up. And yeah, if you just put your name, tax file number, and state. Yeah, there's a couple of things you need to put in, and it will tell you if you've got any money, and it'll tell you where to go. So it's actually a really good thing to do, and just make sure that you do that. So, and finally, the last thing I just wanted to talk about was investment basics. At Perks, we actually have an unrestricted dealer's license, which basically means we can advise clients on any type of investment. We're not restricted on just in managed funds or just shares, etc. In time, this will be something that will be quite relevant for you when you look to build some, investment portfolio for yourself. There are different forms of investments. So there are, like I said, there's cash and fixed interest, shares, managed funds, property. Depending on, there is that actually, so when I talk about risk versus return, there's a direct relationship between risk and return. So obviously, the higher the risk, the higher the return you should expect. The lower risk, lower return. The lower risk assets are things like cash and fixed interest, but you'd expect a lower return. Higher risk assets are shares, managed funds, shares and property, but you would also expect a higher return for that. And what we do is we basically, when I say diversification, we would undertake to build a portfolio for clients that actually is very diversified. Diversification is the best way of reducing risk because it means that you don't have all your eggs in one basket. You don't have, even at the moment, for instance, clients who might say, well, look, I don't want to take any risk, I just want to have my money in fixed interest, in term deposits. It's still taking some risk because as interest rates reduce, and as they're reducing at the moment, which you would hear about in the news and that, they're losing out on their investment income because they're not taking any risk, but interest rates are reducing. So what we say is we would prefer clients to be diversified, spread your assets across various types, but making sure it's all in line with what your objectives are. So that's something we spend quite a lot of time talking clients through, educating the clients on the best way of doing it and advising. The other thing is to make sure that whatever investments you actually undertake, and this is something which I think is really relevant for you guys when you're starting off, make sure that you actually match your investments to your time frame and your goals. So if you want to buy a house in 2 years' time and build up a deposit for that, putting that money in shares wouldn't be the place to do it. For 2 years, 2 years is not long enough to, so share markets basically, they're called long-term investments because they're basically, you'd want to see them there for at least 5 to 7 years. So if you're not going to have that money there for 5 to 7 years, I wouldn't recommend necessarily, unless you want to take high levels of risk, I wouldn't be recommending putting it purely in one share, for instance. So it's about matching things, matching your time frame to your goals. But of course, longer term goals, that would be, fine to do that. So it's about sort of, just looking at it, understanding what those are and then matching it. One of the other big questions we have asked of us quite often is, do I, for instance, somebody might have a house and a mortgage. Do I pay off my mortgage or pay off my investment property loan, or do I invest? And in terms of that question, it really comes down to the figures because, depending on what the interest rates are on the loan that you've got, depending on what the likely investment return you might receive, depending on tax outcomes, etc., it can vary. So there's not any rules of thumb, but I know that that's a question I do get a lot from young people saying, well, look, I've got a mortgage now, I'm buying a house. Should I be paying off my mortgage or should I be investing? We've really got to do the sums and work it out and look at it. So I just thought it would be relevant to bring that one up because, we sort of hear conflicting things where some people say, you should always do it this way, or and it really is case by case. And on that note, financial planning and wealth, building wealth is very much a very personal thing. What's right for the person sitting next to you here wouldn't be necessarily right for you, and I think it's important to make sure that whatever advice you take is really specific to what's best for you. So I'm really happy to catch up with any of you at any time to chat through any of these issues. knowing that, you know, you might not necessarily be in a position to invest or to be able to sort of undertake any ongoing service at the moment, but more so just to kind of help put you on track. I'm more than happy to do that. So feel free at any time to give us a call and pop in and have a coffee, and I can help you with any of those queries that you might have. So, has anyone got any specific questions at all? So, any questions on investing or financial planning? Or, no?
We got the website started.
Huh?
The website.
Oh, there we go.
So I don't know whether the guys went through that last week, but just so you know, so we've got that website put together specifically for you guys. Login and password there, which are pretty straightforward, and it's just got a lot of the information that we've sort of already gone through, just so you guys can peruse that at your leisure, and there's contact details and stuff like that in there if you feel more comfortable going in it that way. But we're happy to answer any other questions now or at any other time. Thank you very much for your time,
Yeah,
guys.
thanks for your time.
Appreciate you coming.
No questions? That's good. Already forgot mine. Don't blame me.
Thank you so much for sharing your financial expertise with us tonight. So,
It's our
appreciate it.
pleasure. Oh, thank you. That's lovely.
Yeah.
Tara, thank you. Yeah.
All right, a round of applause for Pat.